Welcome back to the Deep Dive. Today, we are doing something a little different. I want you to close your eyes. Unless you're driving, please don't close your eyes. And imagine we have hit the fast forward button. We are transporting ourselves slightly into the future. Specifically, the date is February 15th, 2026.
The future is now.
It really is. And in this 2026 landscape, the market is absolutely obsessed with one specific question. We've moved past the initial hype. The question on everyone's mind is, who is going to win the AI application layer?
Right.
We've seen the chip wars. NVIDIA had its incredible run. The custom silicon battles are raging. We've seen the model wars, OpenAI, Google, Anthropic. They've all battled it out for IQ points. But now the smart money is chasing the companies that actually use this stuff to do real work.
Exactly. The infrastructure phase is settling down. The novelty of just chatting with a bot has, it's worn off. We aren't impressed by a poem written by a computer anymore.
Not at all.
Now the market is asking a much harder, much more lucrative question. Where is the value actually accruing in the enterprise? Who is monetizing this technology to change how business gets done?
And that brings us to the subject of today's deep dive, ServiceNow.
A giant.
Ticker symbol, NNOW.
An absolute behemoth in the SaaS world.
It really is. And look, if you're listening to this, you probably know the basics. It's a SaaS juggernaut. We're talking over $13 billion in revenue. The market, they call it the AI operating system for the enterprise. But, and this is the deep dive we are conducting today is based on a specific, rather provocative source document. It's a skeptical buy-side deep dive dated today, February 15th, 2026.
And skeptical is the operative word there. We are not here to read the investor relations slide deck. We're here to tear it apart.
The core tension we're going to explore is ServiceNow a good company? I think we can spoil that and say, yes, clearly it is. You don't get to $13 billion in revenue by accident.
No, you don't.
The real question is this stock a bulletproof investment right now?
Yeah.
The framework we are using forces us to ask, what could go wrong?
And that distinction is it's vital. You can love a product. You can admire a CEO like Bill McDermott. You can even use the software every day in your own job. But you can still lose money on the stock if the underwriting assumes perfection and the reality has cracks. And this report argues there are cracks.
So here is our roadmap for this deep dive. First, we're going to break down the AI orchestration thesis. This is the bull case, the idea that ServiceNow is the nervous system of the modern company.
Right.
Then we're going to audit the financial durability. We'll look at the growth versus the profitability, that classic tug of war.
Then we get to the part that really caught my eye in the report. We are going to uncover some buried risks in the filings. And I'm not talking about vague macro risks like interest rates or, geopolitical tension.
No.
I mean, specifically, one massive concentration risk that is hiding in plain sight in the 2025 10K. It's a number that once you see it, you just can't unsee.
And finally, we will deliver a final verdict based strictly on this provided skeptical report. Is it a buy? Is it a pass? Or is it something a little more nuanced?
Let's get into it.
Okay, let's unpack this. Section 1. The thesis, the AI orchestration layer. To understand where ServiceNow is today in 2026, we have to look at where they came from. I feel like a lot of people outside of tech IT departments still think of them as the IT help desk guys.
Oh, for sure.
The place you go to reset your password when you forget it for the third time in a month.
Which is fair. Historically, that was their wedge. That's how they got into the enterprise, 15 years ago? You have a broken laptop, you need a password reset, you file a ticket. ServiceNow was the cloud platform that made that suck less.
Right.
It replaced these endless email threads and spreadsheets with a structured workflow. But if you look at the 2025 10K, that definition is its ancient history. They don't frame themselves as a ticketing system anymore. They frame themselves as the execution and orchestration layer.
Orchestration. It's such a buzzword in tech. It sounds fancy, but what does that actually mean in practice? Give me a concrete example.
Think about it this way. We have all these generative AI models now, right? LLMs. They can write emails, they can summarize documents, they can suggest code. But an LLM is just a brain in a jar.
A brain in a jar. I like that.
It can think, but it can't act. It can't log into SAP and move money. It can't provision a server in AWS. It can't approve a hire in Workday.
It has no hands. It's a brain without a body.
Exactly. It has no hands. ServiceNow is arguing, we are the hands.
I love that analogy. It's so clear.
Their pitch is that AI generates the insight, but the enterprise needs a secure, governed infrastructure to control and act on that insight. Let's say an AI agent analyzing your supply chain says, hey, we are going to run out of copper wire in 3 weeks because of a strike at the port.
Okay, that's great insight.
A fantastic insight, but then what? The AI can't just wish the copper wire into existence.
Right, it can't just snap its fingers.
Exactly. ServiceNow claims to be the layer that takes that insight and triggers the workflow. It automatically checks alternative suppliers, generates a purchase order, routes it to the procurement manager for approval, because you usually want a human in the loop for money,
Definitely for the money part.
sends the order to the supplier, and updates the ERP ledger. That entire chain of events is the nervous system.
So if the LLM is the brain generating ideas, ServiceNow is the nervous system that connects the brain to the muscles, the actual systems of record, like SAP, Oracle, Workday, or Salesforce.
Precisely. And that positioning is incredibly strategic, because if they truly own that action layer, they have a massive moat.
Why is that a moat? Why couldn't Microsoft just do that? I mean, they own the OS, they own the productivity suite. Why can't they be the nervous system?
Well, they can try. And believe me, they are trying. But think about the sheer complexity of the enterprise. You aren't just connecting to Microsoft products. A large company has thousands of different legacy systems, some on the cloud, some on-premise, some that are, 20 years old and written in COBOL.
Right, the stuff no one wants to touch.
Handling the security permissions, ensuring compliance, mapping all the data fields, that is messy, unsexy work. ServiceNow has spent 20 years building those integrations.
It's the plumbing. Nobody notices the plumbing until it leaks, but you absolutely cannot build a house without it.
Correct. If they are just a system of record for IT tickets, they are vulnerable. Microsoft could bundle a ticketing system into Office 365 and, maybe wipe them out. But if they are the plumbing that connects everything, HR, customer service, IT, legal, then ripping them out becomes a nightmare.
It's not an app decision at that
It
point.
becomes an operating system decision. It's the difference between being an app on your phone, which you can delete in 2 seconds, and being the iOS that runs the phone.
Or at least the layer that sits right on top of the OS managing all the traffic.
Exactly. And the scale here, it supports that ambition. We aren't talking about a startup trying to prove a concept. This isn't some Series B company with a nice slide deck and a dream.
Let's look at those numbers because the scale's massive. In 2020, they were doing about, $4.5 billion in revenue?
Around there.
Flash forward to the fiscal year 2025, which just ended in this scenario, and they hit roughly $13.3 billion.
That is a staggering amount of growth at that scale.
Yeah.
Tripling revenue in 5 or 6 years when you are already in the billions is not normal. It's a mega cap compounder. Most companies hit a wall around 5 or 10 billion where gravity just takes over. ServiceNow hasn't hit that wall.
And the quality of that revenue,
Yeah.
we always talk about quality of revenue. Not all dollars are created equal.
It's the gold standard. 97% of that 13.3 billion is subscription-based.
Wow.
That's $12.8 billion in recurring revenue. This isn't a consultancy model where you have to hunt for every meal or a hardware model where you have to ship a new box every quarter. This is a machine that wakes up on January 1st with nearly 13 billion virtually guaranteed before they even sell a single new contract.
That predictability is what Wall Street pays a premium for. It allows them to plan, to invest, to hire.
Exactly. But here is the framing question for this section. Why does this positioning as the action layer matter for long-term value?
Yeah, why does it matter? It sounds good, but what's the tangible impact?
Because if they truly own it, they have pricing power. They can charge a tax on every single AI action taken in the enterprise. But if that narrative is just marketing fluff, and really they are just a place where people log complaints, then AI might actually help them.
How so? How could it hurt them?
Well, if AI becomes good enough to fix your laptop automatically, or reset your password without a ticket, or answer your HR question without a human, then you don't need a ticketing system anymore.
The volume of tickets goes down.
Volume goes down. So the bet you are making as an investor is that ServiceNow is essential to the process of work, the complex orchestration, not just the recording of work. They have to move up the value chain to survive this AI wave.
That's a crucial distinction. If they stay in tickets, they die. If they move to orchestration, they rule the world.
That's the binary outcome we are looking at, and the market is clearly betting on orchestration.
Okay, let's shift gears. We've looked at the shiny brochure, the AI nervous system. It sounds great. The host in me is excited, but the expert in you is giving me that look.
You know the look.
You always say stories are great, but let's look at the checkbook.
The checkbook never lies. The narrative can be as poetic as you want, but the P&L is where the truth lives.
So does the growth hold up when we actually drill into the P&L? Let's move to Section 2, Financial Health. We're balancing growth at scale against the cost of doing business.
Right. So we mentioned the revenue total of $13.3 billion, but let's look at the momentum. In Q4 2025, their subscription growth was 21%.
21%.
If you adjust for currency fluctuations, because the dollar moves around, it was 19.5% in constant currency.
21% growth. For a company of this size, that feels fast.
It is exceptionally fast. There is a law of large numbers in gravity that usually pulls you down to 10 or 12% once you hit 10 billion. Growing greater than 20% at a $13 billion scale is rare. It puts them in a very elite club of software companies.
And that suggests their platform strategy is working, right? They're not just finding new customers, they're selling more and more products to the ones they already have.
Exactly. They are selling HR, CSM, creator workflows, all to the same customers. The land and expand model is firing on all cylinders.
Management talks about this a lot. I was reading the transcript from the Q4 call. Bill McDermott, the CEO, he loves to talk about large deals.
He does. He's a master salesman. He has a way of making every deal sound like the most important event in corporate history. But the data backs him up. In the Q4 2025 call, they highlighted 244 deals with a net new annual contract value, or NNSCV, of over $1 million.
244.
Just in the quarter.
$244 million deals in 3 months. That is almost 3 a day. That is serious enterprise adoption. That's not small businesses signing up. That's the Fortune 500 doubling down.
It is. And another metric we look at, and it's a bit of jargon, is CRPO, current remaining performance obligations.
We love our acronyms here. Break that one down for us.
I know, it's a mouthful. But this one is important. CRPO is essentially the revenue they have under contract that will be recognized in the next 12 months. It's the money in the bank for the coming year. That grew 25%.
Wait, so the backlog, the CRPO, is growing faster than the revenue.
That's a very bullish signal. It means the pipeline is accelerating, not slowing down. It suggests 2026 is already off to a strong start. If CRPO was growing, say, 15%, and revenue was growing 21%, I'd be worried.
Right, because that would mean they're burning through their backlog.
Exactly, they're eating their seed corn. But here, they are building backlog. They're refilling the hopper faster than they're emptying it.
Okay, so the top line is humming. But what about the bottom line? Are they burning cash to do this? Is this profitless prosperity?
Historically, SaaS companies were famous for growth at all costs. You know the drill.
Uh-huh.
Burn $1 to make 50 cents and hope you make it up on volume eventually. ServiceNow has successfully transitioned out of that phase. Their GAAP operating income, and I stress GAAP, the real accounting number with all the expenses included.
The one that matters.
The one that matters. It's $1.82 billion. That's a margin of about 13.7%.
That's respectable for a high-growth company. Many SaaS companies are still GAAP unprofitable at this stage.
Correct. But if you look at the non-GAAP or cash metrics, it's even wilder. Operating margin is 31%. Free cash flow margin is 35%.
35% free cash flow margin on $13 billion in revenue. That's billions of dollars of cash.
Correct. Operating cash flow was over $5.4 billion in FY 2025. They are a cash machine. They have proven they can grow and be profitable simultaneously. This is the rule of 40, where growth plus margin should equal 40. They are at like rule of 50 or 60.
Okay, I'm hearing a lot of good news. I feel like I should just go buy this stock right now. Where is the skepticism? You promised me a skeptical deep dive.
Here is where we start to put on the forensic hat. There is a nuance in the 10K that most people skim over because it sounds technical and boring. It's about self-hosted revenue.
Self-hosted. I thought this was the cloud. I thought the whole point was SaaS.
It is primarily.
Yeah.
But they have some customers, usually highly regulated ones or maybe strict government agencies who host the software themselves on their own servers or private clouds. The 10K reveals that about $492 million in subscription revenue comes from self-hosted software.
Okay, nearly $500 million. Why does that matter? Revenue is revenue, right?
Not exactly. It matters because of accounting rules, specifically ASC 606. When you sell a cloud subscription, you recognize the revenue day by day, ratably over the year. It's smooth, it's predictable.
Yeah.
When you sell self-hosted software, you often recognize a huge chunk of it up front the moment you hand over the license key.
I see where you're going.
Yeah.
It's like eating the whole cake in one sitting instead of a slice a day.
Perfect analogy. It's not bad revenue, it's real money, but it behaves differently. It can flatter the growth numbers in the short term. If you have a slow quarter in the cloud business, but you manage to close one massive self-hosted deal with a government agency, you can recognize $50 million all at once. That can make your growth rate look like 21% when maybe the underlying recurring cloud growth was only 19.
So a skeptical investor watches this number to ensure it's not being used to mask a slowdown in the pure cloud bookings.
Exactly. You want to make sure the quality of the growth is consistent. The report notes that this self-hosted portion is growing. It's something to watch. If it spikes, you have to ask, is the growth real, organic, recurring growth, or is it a sugar high from upfront recognition?
That is super nuanced. I love that.
Right.
And what about the cost to get that growth? You mentioned margins are up, but are they spending efficiently?
They are becoming more efficient, yes, but the absolute numbers are still eye-watering. Sales and marketing, or S&M expense, was $4.38 billion.
$4.4 billion just on sales and marketing.
Yes, that's almost a third of their revenue. To maintain that 20% growth rate, they have to feed the beast. They are spending heavily to acquire customers, wining and dining, huge sales commissions, massive conferences in Vegas. The question is, does that leverage improve over time? Can they grow 20% without spending $4 billion? We haven't seen that yet. The efficiency is good, but the intensity of the spend is still very high.
Okay, so we have a growing, profitable giant. It sounds like a slam dunk. This is where we usually say buy. But you're telling me this is where we need to pause.
This is exactly where you pause, because great company does not always equal great investment. We have to look at the risks that could blow up the thesis. And in this report, there are two specific numbers that should stop you in your tracks.
Let's transition to Section 3, the skeptical red flags. We're talking concentration and compensation. This is the juicy stuff.
Let's start with the big one. Concentration. In the risk factors of the 2025 10K section, most people skip because it's usually just boilerplate legal jargon, they explicitly state that one customer accounted for 11% of their total revenue.
11% of $13 billion.
Yes. Do the math. That is over $1.4 billion flowing through a single pipe.
Who is it? Is it the U.S. government? Is it Walmart? Is it Amazon?
The filing describes it as a U.S. federal channel partner and systems integrator.
Okay, let's unpack that. A channel partner, so it's not the end customer like the Department of Defense itself.
Likely not. It's a middleman, a huge systems integrator. Think of a company like Carahsoft or a similar entity that facilitates government contracts. The government often doesn't buy directly from ServiceNow. They buy through these approved vehicles for ease of procurement.
Okay, so why is this a red flag? If the government is buying, isn't that good? I mean, the U.S. government pays its bills. They have a printing press.
It is good that the government is buying. Public sector demand is great. But the structure of the risk is the problem. This is what we call binary tail risk.
Explain that.
Imagine you are renting out an apartment building. If you have 100 tenants and one moves out, you lose 1% of your income. No big deal. You repaint and lease it again. But if you lease the whole building to one company, say WeWork back in the day, and they go bust or have a dispute with you, you lose 100% of your income overnight. ServiceNow has $1.4 billion dependent on this one single relationship. What if that partner has a compliance issue? What if they get investigated by the DOJ? What if there's a contract dispute? What if the government changes procurement rules and freezes that partner out?
Then ServiceNow takes a massive, immediate hit to revenue.
Exactly. Even if the end demand is fine, even if the Army and the Navy still want the software, if the pipe breaks, the revenue stops. For a stock that is priced for perfection, you cannot have a double-digit dependency on a single intermediary. It violates the sleep well at night rule.
It's a single point of failure.
It is. And in a nearly bulletproof underwriting framework, which is what we are applying here from this report, that is a disqualifier. You want diversification. 11% is just way too high.
That is a massive nugget. Most people probably just see government revenue and think safe. You're saying channel partner concentration means fragile.
Precisely. And remember, the report notes that accounts receivable from this partner was also 11%. So they owe ServiceNow a lot of cash at any given time. If that partner sneezes, ServiceNow catches a very bad cold.
Okay, point taken. That's a huge risk. Now let's look at the second red flag from the report. How the employees get paid. Stock-based compensation or SBC.
This is a classic tech debate. It divides the investing world, and for good reason.
The employees get stock. It aligns incentives. They want the stock to go up. I get stock options, you get stock options. What's the problem?
The problem is the scale and the offset. In FY 2025, ServiceNow spent $1.84 billion repurchasing its own stock. Buybacks.
Usually investors love buybacks. It means the company thinks the stock is cheap. It reduces the share count, which makes my earnings per share go up. It's returning capital to shareholders.
Usually, that's the theory. But you have to look at the other side of the ledger. In the same period, stock-based compensation was roughly $1.955 billion.
Wait, so they issued almost $2 billion in stock to employees and spent $1.8 billion buying stock back.
Correct. They are running on a treadmill. The buybacks are essentially just mopping up the dilution from the employee equity grants. They aren't shrinking the share count meaningfully to benefit you, the shareholder. They are just treading water.
So all that cash flow we talked about, that $5 billion in operating cash, a huge chunk of it is going out the door just to keep the share count flat.
Yes. It is a transfer of wealth from shareholders to employees. Now, to be fair, this is common in tech. You have to pay for talent. Engineers are expensive, especially AI engineers. But as a skeptical investor, you have to count that SBC as a real expense.
Right.
Management likes to pretend it's a non-cash expense and add it back to their non-GAAP earnings. But if they are using real cash to buy back the shares to offset it, it is absolutely a cash expense.
That's a great point. If you ignore SBC, the margins look amazing. If you treat it as a real cash cost because of the buybacks, the margins compress significantly.
Exactly. It drags on your real returns. The owner earnings are lower than the headline number. You aren't getting the full benefit of that $5 billion cash flow. The employees are getting a big slice of it first.
And there was a third red flag in the report, something about missing data.
Yes. This is a procedural foul, but an important one for this particular framework. The source set for this deep dive notes the absence of the most recent 10Q and the proxy statement.
Why does the proxy matter? That's usually just boring governance stuff. Who's on the board? When is the annual meeting?
The proxy is where the secrets of motivation are buried. It tells you exactly how the executives are paid. It breaks down the formula for their bonus. Are they paid on revenue growth? Or are they paid on return on invested capital or ROIC?
If they are paid on growth.
Then they are incentivized to spend that $4.4 billion on marketing, regardless of efficiency. They just want the top line to move because that triggers their bonus.
And if they are paid on ROIC.
Then they are incentivized to be disciplined, to make sure every dollar spent yields a return. Without the proxy, we can't verify their incentives. We are flying blind on what motivates Bill McDermott's paycheck. And a skeptical framework penalizes this lack of transparency. You assume the worst until proven otherwise.
Okay, that's a heavy section. We have a $1.4 billion single point of failure in the partner channel. We have a dilution treadmill where shareholders are paying the employees. And we have a blind spot on executive incentives.
Correct.
So we've looked at the specific risks. Now let's bridge this to the broader strategic picture regarding AI. Everyone is buying this stock for AI. Is AI actually a windfall or is it a margin trap? Let's move to section 4, the AI reality check.
This is the future-looking part of the analysis, and it ties right back to that orchestration thesis we started with.
Management is pushing this hard. In the 2024 and 2025 calls, they are talking nonstop about Pro Plus. This is their premium AI packaging.
Right. Pro Plus is the SKU where you get the generative AI features, the summarization, the code generation, the conversational search. And they claim adoption is rapid. They also mentioned the integration of MoveWorks, a company they presumably acquired or partnered with as de minimis, which is a fancy way of saying it was tiny.
So they're implying their organic growth is driving the AI story.
That's the implication. They aren't just buying revenue through M&A.
So customers are buying it. That's good. But here's the question. Is it profitable?
That is the multi-billion-dollar question. The report calls this the cost-to-serve risk.
Because running an LLM isn't like running a simple database?
Not at all. Every time you ask an AI question, it burns electricity, it burns GPU cycles, it sends a query to a model that costs money to run. It is very, very expensive. The skeptical report suggests a Scenario B failure mode.
Scenario B, what was Scenario A?
Scenario A was the partner risk the pipe breaking. Scenario B is the profitless prosperity of AI. Imagine AI drives a huge price uplift, everyone buys Pro Plus, revenue goes up, hooray!
Sounds good so far.
But the cost to run those models explodes. NVIDIA gets paid. The cloud providers get paid. And ServiceNow's gross margins, which are currently sky high, around 80%, start to crunch down.
So they might get the revenue, but keep less and less of the profit.
Exactly. It's a compute tax. We have to watch the gross margins like a hawk in future quarters. If revenue goes up 20%, but cost of revenue goes up 40%, we have a serious problem. We haven't seen it yet, but it's a structural risk of generative AI for every application company.
And what about the competitive moat? We talked about the orchestration layer. But Microsoft has Copilot. Salesforce has Einstein. Everyone has an agent now. The report mentions a crowded battlefield.
This is the existential threat. Does AI make ServiceNow stickier, or does it commoditize them? The bull case says, yes, it makes them stickier.
Yeah.
Because once the AI is trained on your specific workflows, your hiring process, your IT security protocols, it becomes incredibly smart and indispensable. You can't just switch to Microsoft because Microsoft's Copilot doesn't know your internal process like ServiceNow does.
And the bear case.
The bear case says, Microsoft gives you Copilot for free, or for $20 a month bundled with Office. Salesforce bundles their agent. Suddenly, ServiceNow looks like an expensive add-on. If the orchestration becomes a commodity feature included in your email provider, ServiceNow loses its pricing power. Why pay ServiceNow $100 a user when Microsoft does 80% of it for basically free?
So the question is AI a moat widener or a moat filler?
We don't know yet, but the skeptical framework demands we consider the risk that it's not strictly accretive to margins. We can't just assume AI extroph it.
This brings us to the moment of truth. We've looked at the good, the growth, the cash flow. We've looked at the bad, the partner risk, the dilution. We've looked at the ugly, the potential AI margin crunch.
Section 5.
The verdict, based strictly on the provided report and this skeptical framework, is ServiceNow investable today, February 15, 2026?
The decision, based strictly on this framework, is not investable.
Wow, not investable. Even with $13 billion in revenue and 35% cash margins, that feels harsh.
It is harsh. But underwriting is about discipline, not emotion. And I want to be very clear about the nuance here. This does not mean it is a bad company. It is a high-quality compounder. It is a machine.
Yeah.
If you own it for the last 5 years, you were very, very happy.
Right.
But investing is about risk-adjusted returns moving forward. And it fails the specific underwriting bar from this report for the 3 reasons we discussed. 1, material concentration risk. That 11% federal partner dependency is a structural flaw. You cannot bet the farm when 11% of the revenue relies on one intermediary that could fail.
Okay.
2, dilution economics. The buybacks are barely offsetting the SBC. You, the shareholder, aren't getting richer. You're just not getting core. And 3, incomplete data. Without the proxy to verify executive incentives, we just can't trust the alignment.
So it's like looking at a Ferrari. It's beautiful, it's fast, but the dealer won't let you look under the hood, and you know for a fact that one of the tires is a retread that might blow out at high speed.
That is a perfect analogy. You admire the Ferrari as it drives by, you take a picture of it, you don't put your life savings into it, not until you can check that tire.
What would change the verdict? What would make us turn this red light into a green light? Because I want to like this stock. It's a great business.
3 things would need to happen, according to this framework. First, that partner concentration needs to drop significantly. If that 11% becomes 5% or 3%, the risk is manageable. Or if they can prove that the contracts are bulletproof and portable, maybe we reconsider.
Okay, that's number 1.
Second, we need proof that buybacks are actually reducing the share count. I want to see the share count go down by 2 or 3% a year. That means the company is actually returning capital to me, not just to the employees.
Makes sense.
And the third,
we need to see continued stability in net retention without excessive discounting. We need to know they aren't slashing prices to keep that 21% growth alive. If we see discounting spike in the financials, that's a huge warning sign. Clear criteria. I like that. It gives us something to watch for in the Q1 and Q2 reports of 2026. So let's wrap this up with a recap for our listeners. If you zoned out during the accounting talk, here is the cheat sheet.
Sure. 1, the pivot. ServiceNow has successfully evolved from IT tickets to the enterprise AI nervous system. That narrative is real, and the product supports it. That's the bull case.
Right.
2, the numbers. Strong top-line growth at 21% and expanding margins at 31% prove the model works at scale. They are printing cash.
And 3.
And 3, the deal breaker. That 11% revenue concentration in a single federal partner is a structural risk that, for this framework, prevents a safe rating today.
And my final thought is this. In investing, sometimes the hardest thing to do is to say no to a great business. We all want to own the winners. ServiceNow is a winner. But the terms, the price, the risk profile, the specific hidden dangers mean that sometimes you have to sit on the sidelines and wait for a better pitch.
Exactly. Great business and great investment are 2 different things. Today, based on this deep dive. ServiceNow is the former, but not necessarily the latter.
And on that note, we'll leave you to mull that over. Thanks for listening to the AI Investment Memo on the Deep Dive. Keep digging.
Keep digging.